Alrighty. So today's video, we're going to be talking about rolling LEAPS options for long-term profitability. Now, if you haven't watched my other videos on LEAPS options, more specifically on using LEAPS options as a stock replacement strategy and how to enter them as a trade, then go ahead and watch that video first. I've put a link right at the top right-hand corner of this video so you can watch it. But in this video, we're going to be continuing the topic of LEAPS, right? More specifically, we're going to talk about rolling LEAPS options. Why you want to roll it, how you're going to roll it, and when you're going to roll it. All right, so first thing, what we want to first have an assumption is that we're only going to be talking about deep in the money call LEAPS as a stock replacement strategy, right? So we're not going to be talking about put LEAPS where you use them as an insurance in case the market crashes, right? For this video, we're going to be talking about rolling call LEAPS as a form of continuing a long-term investment into the stock or ETF that you want to invest in, right? So for this, what we're going to be talking about is where we have a deep in the money call LEAPS with a delta of more than 0.80 and days to expiration of more than 365 days. Now, why do you want to roll it, right? Why do you want to roll it in the first place when you can just close the deep in the money call LEAPS, right? Yes, you can of course just go ahead and close it. But what if you are still bullish on a long-term view and you are currently still in a loss for your LEAPS, right? So when you're rolling it, basically what you can do by rolling is to extend the life of your LEAPS. When you extend the life of your LEAPS, you actually also continue your long-term bullish view on the underlying stock, right? If you still feel that the market is going to go up in the long term, especially if you are buying a deep in the money call LEAPS in ETFs such as IWM, QQQ, Spiders, where they will go up in the long term, then you definitely do want to roll it, because when you roll it, you actually increase your chance of profitability, right? If you close it out right now and then you don't re-enter into a trade, then if you're in a loss, you're just going to take a loss, right? But if you roll it, you can still continue the life of this position as though you would if you were holding on to stocks. Right, so when do you want to roll it? So you want to roll it if you are still bullish on the underlying stock, regardless if it's in a profit or loss. Now, this is very important to understand, because if you are no longer bullish on the underlying stock, then it's better to just close the option altogether. Right? If you are hoping that the market will somehow go back up again and you just want to keep rolling it, then it may actually end up in a bigger loss for you, because each time when you roll, if you are in a loss and each time you roll it, you're actually adding more to your initial risk, right? When you're prolonging life, you always have to pay more extrinsic value. So you only want to roll it if you're still bullish on the underlying stock. So in many of my cases, most of the LEAPS which I have is on the index ETFs, so I have no worries just extending the life of it, just rolling it, because I know in the long term the market will always want to go up, right? So the next thing is, when do you want to roll it? Right, I generally want to roll it when there's less than 90 days left to expiration. Most of the time when I buy the LEAPS, right, it will be around 400 to 500 days to expiration, so I'll be holding it for quite a long time. So when it left roughly less than 90 days, that's when the theta will really start to pick up, right? So this is the time when, instead of letting the remaining extrinsic value decay, I would rather just roll it out to the furthest days to expiration available, so that I can prolong it and keep the theta decay low as well. So how do you want to roll it, right? So there are two cases in which you want to roll it. So first is if you are in a profit, right? So if you are in a profit, you will basically just roll out and up to take some profit and re-establish the initial delta. So chances are, let's say if we enter into the LEAPS at the start, your delta will be roughly maybe somewhere around, let's take 0.90, right? So you'll be buying a LEAPS at 0.90, and as the market goes up, your delta will also increase as well, because delta increases as the underlying stock moves up or down, right? So in this case, if the market is to keep going up, then your delta would to go up as well. It will keep going up all the way. Eventually, it reaches close to 1.00, very close. So in this case, if the market has gone up since when you bought the LEAPS option, then your delta will pretty much increase as well. So it may increase all the way to maybe 0.98 at this point. Let's say if the market has really shot up a lot. So at this point of time, when you roll it, what you're doing is that you are selling away this option that has gone to 0.98, and then you're buying again to re-establish the initial delta back to 0.90 again. So you're selling the delta at 0.98 and then you're buying back the 0.90. So this way you will always be taking some profit off the table and re-establishing the initial delta. So I will go through this more with you with an actual trade example so you can have a better understanding. But for now, understand that if your LEAPS option is in a profit, then you most likely only want to do a roll out and roll up, right? Roll out and up to take some profit off the table. Now, this is more of the trouble, or rather more of the dilemma you have to face if you're in a loss, right? Say you enter into your call LEAPS option, and then the market has dropped since when you entered. So most likely, let's say for example, you started off with 0.90, and as the market went down, your delta also went down, and let's say your delta goes all the way down to maybe something like 0.70. So at this point of time, you are still bullish in the outlook of your stock. Let's say you still think that the market will still go up in the long term, you want to continue this position, then there's two ways for you to roll this, right? The first way you want to roll is to simply just roll out to re-establish the same strike price, right? Let's say for example, the strike price that you entered down here, let's say it's $100 strike price. Let's just say for example it's 100 strike price is 0.9 deltas, right? So if you were to roll out, basically you will still be rolling to the same strike price at 100, and then you will be re-establishing the same initial risk which you had, which the initial intrinsic value risk, right? So for example, if you roll from 0.7 with a DTE, let's say it has DTE of 60 left, and then you roll it out to the DTE of another, let's say DTE of 500, so you're renewing all the way by more than a year. So what you want to do is that you will still keep the same 100 strike price, right? If you keep the 100 strike price, your intrinsic value is still the same, but you would need to pay more in terms of your extrinsic value, because remember, extrinsic value is highest when it's closer at the money. So when you first started off, you bought a LEAPS option where the delta is 0.9. So this is very deep in the money. So when it's deep in the money, your extrinsic value is much lesser. But now that it has gone to 0.70, your delta has dropped, your extrinsic value has actually increased, right? So your extrinsic value has increased because it is now closer to at the money, which is around 0.5, right? So you go from deep in the money to slightly closer to at the money. At this point of time, your extrinsic value has increased, and if you were to roll to the same strike, then your extrinsic value will be rolling from this amount to a higher amount as well. That is why you'll be paying more in terms of extrinsic value. So in this case, although you keep your intrinsic value risk the same, you'll be actually increasing your extrinsic value risk, because previously you bought a certain amount of extrinsic value. When you roll it to a further days to expiration that is closer at the money, you're going to pay much more in extrinsic value. And again, I'm going to show this to you in example later on, but for now you just need to understand that this is actually increasing the most in terms, you're paying the most in terms of extrinsic value. Now the next would be to roll out and down to re-establish your initial delta, right? So in this case, you have 0.7. Okay, so now instead of rolling to the same strike price, you want to roll to a lower strike price. So let me just draw an arrow down here. If you roll to a lower strike price, let's say you roll to an 80 strike price this time, from 100 to 80, what happens is that you're actually topping up the intrinsic value gain, right? You're topping up the intrinsic value gain from 100 to 80. So this is where you are topping up your money, where you're paying the difference between from 100 to 80, which is about 20 points, right? So you're paying up about $2,000 more in terms of intrinsic value. And for this, you'll be paying lesser extrinsic value, because right now, what you have done is you have shifted from 0.7 deltas, you have shifted all the way to maybe to re-establish the same delta at 0.90. So if you were to re-establish the same initial delta which you first bought or initiated your leaps at, what will happen is that your extrinsic value will be roughly the same as when you first bought it, alright, given that the days to expiration is similar and the volatility doesn't really change much, right? So what you're doing instead is you're topping up intrinsic value and then you're paying a little in terms of extrinsic value. So let's take a look at some trade examples so you understand what I mean. By the way, if this video has been helpful to you so far, please give me a thumbs up and hit the subscribe button so I can create more videos like this for you in the future. Okay, back to the video. Alright, so let's take a look at the first trade example. This is if you are in a profit. Alright, so this is on UNH. I bought a LEAPS, a deep in the money call LEAPS somewhere around this price down here on the 1st of October, as you can see. Now, this was part of a poor man's cover call trade where I had a short call as well to accompany this call LEAP, right? But for this example, right, I'm just going to show you the long call LEAP side, right, of how I manage this deep in the money call LEAP. So as you can see on this date down here, I bought the deep in the money call LEAP and the market has gone all the way up, right? It has gone pretty high from when I first entered my trade. Now, I've already gotten out of my trade roughly around 480, 470. It was quite a decent profit, but of course, you know, if I held longer, it would have made more, but who knows, right? So let's take a look at the option chain to take a look at how much it would be worth right now if I held on to this deep in the money call LEAP. So you can see that I bought it for $187.72, right? So that's roughly $18,700. So this has an expiration of 20 January 2023. So as of this video, there's still quite some time left. There's about 151 days left. So this is the strike which I bought. All right, so it is a 200 strike call LEAP, right? So you can see at this 200 strike price, you can see that the price right now, the mark is roughly $348, right? Around 350. I bought it for 187, which is not bad, which is quite a good, decent profit. So when I first initiated the trade, it was around 0.90 deltas, right? I bought it at roughly 0.90 deltas, and if you take a look at the delta now, it has gone up considerably. It's very close to 1, and this is pretty much, I think this is the maximum which the delta can go for this LEAP option. So it's pretty much 1 for $1 move right now. Every $1 move the underlying stock moves, the call LEAP option will also gain by 99 cents, close to $1. So at this point of time, let's say that there is roughly 90 days left, right? Let's assume there's 90 days left and I want to roll it. So if I want to roll it, there's two ways I can consider doing that, right? The first way is to roll it to the same strike. So from the 200 strike, I'm going to roll it to the same 200 strike. So in this case, I still keep the same intrinsic value, right? I do not change it at all. All I'm doing is that I'll be topping up the extrinsic value, which is this number down here, right? So this extrinsic is $4, and the extrinsic value that I currently have is about 65 cents. So basically what I'll be doing is that I will be selling off this. I'll be selling roughly around 349 and I will be buying it at 352. So if you notice, this will be a debit, right? I'll be paying roughly about $2 to $3 to extend the life of this option, this call LEAPS, which is actually not too bad, right? Considering I'm only going to pay $200 to $300 to extend another maybe 400 days, 300 to 400 days, about a year, which is pretty good, right? But the thing is that I'm already in profit, right? I already made quite a bit of money on this trade. Why do I want to, you know, pay a little bit more, you know, increase my overall break even and overall risk when I'm already in profit? What I would rather do is to take the trade, right, some profits off the table, right? For example, if you were to own shares, what you might consider doing is to take a few shares off the table. You sell some shares to collect some profit. So in a sense, this is very similar, because for the LEAPS option, you can actually just roll to a higher strike price, right? When I first started off, it was 200 strike. I can roll to re-establish the same delta, right? So if the delta is 90, I'll just take a look at the delta which I want to re-establish, and I can see that it is at this strike price, which is 310. So instead, I would just roll it to the 310 strike price, right? So what I'll be doing is I'll be selling away the 200 strike price. I'll be selling away at roughly $349 and then buying at roughly $253. So what does this do? Right, so this is actually a credit roll because I am selling away the more expensive option, and then now I'm buying a cheaper option. So what this does is actually it takes profit off the table, and at the same time I'm still continuing my long-term bullish view on the stock. Right, let's say I'm still very bullish, I think it will continue to go up, I will do this roll. Alright, so as you can see, if I were to roll from the 200 strike price, I roll to the 310 strike price to reinitiate the original 0.90 deltas, then you will see that the amount I will receive is actually a credit. So I'll actually be paid $9,547 just to roll to a higher strike price, because right now I'm just taking profits off the table, right? I'm taking profits off the table, I'm reducing my initial risk as well. So let's say in case, let's say touch wood, the market was to crash and somehow it goes to zero, I'm not going to lose that much overall because I've already taken some credit off the table of my initial risk. The initial risk was 187. I've already taken off roughly 95, so that's about half, I would say. So there's only half of the risk left on the table. All right, so this is how I roll it if it's in profit. Now let's take a look at the next trade example, and this is if you are in a loss, and this is a current trade that I am still holding on to, and that is CRM. So you can see on this date, roughly on the 10th of January 2022, right, I entered into a deep in the money call LEAP at roughly this price, right? Is around 220 something, right? So I paid $115 for the strike at 115, right? So this is just nice 50% of the total price that I'm paying for the LEAPS option, right? So $115 is my total risk. So at this point of time, you can see the moment I entered, the market has just gone in a very just downward move, right? The market is going down, and right now this call LEAP is still in a loss, and I'm holding on to it because I'm still very bullish on CRM in the very long term. So what do I want to do? Now that there's a lesser time left in the expiration date, so again, as you can see, there's a position down here. I have an existing position down here. So at the moment, I'm not looking to roll because there's still 151 days left, right? I'm only looking to roll once there's a lesser than 90 days left. So let's say if I were to roll this right now, right, you can see there are two options that you can choose to roll to, right? So this is the strike, 115. Now I can choose to roll to the same strike price, right? If I roll to 115, what is happening right here is that I'm actually maintaining the intrinsic value risk, right? The intrinsic value has not changed since I've purchased it because I'm rolling to the same strike, but what has increased is my extrinsic value, because right now I'm paying more for the extrinsic value to extend the life from 151 to the 515 days to expiration. So if you were to take a look at this roll, which is this one down here, right, the roll which I'm doing is to the same strike price but to a further expiration date, and you can see that I'm actually paying a debit of $9.60. So I'm paying $960 to extend the life from 151 to 515. So when I do this, what happens is that I'm maintaining the same intrinsic value risk, but I'm extending or increasing my extrinsic value risk just to increase the life of these options. So this delta, you can see, has gone from 0.92, or rather 0.92. It will decrease to 0.87 with the same strike price. So because this price right now at 115 is the same strike as this, as the time increases, this delta actually drops. It drops lesser and it's more closer towards the at the money, and that's why your extrinsic value is pretty high, right? It's much higher than if you were to bought somewhere around 0.90. So when I increase the lifespan of this, I'm paying much more in 960, which also means I increase my overall break-even price. So my break-even price, the original this, would be the amount I paid for plus the strike. So it would be $230. Right? So this is one thing to take note of when you are rolling out just to the same strike. When I do this, I pay an additional 960. So right now, my overall risk will increase by 960. So if I add this by 960, right now my break even is no longer at 230. My break even right now will be at 239.60. So now I've increased the break even by $9.60, but I only pay, much lesser than if I were to roll out and down. All right, so this is the next roll that you can consider doing. This will be rolling out and down. So what happens down here is that instead of rolling to the same strike, you want to roll to a deeper in the money strike. So you roll to the 80 strike price. What happened is that you're actually going to top up the intrinsic value from 115 to 80. Right, so previously, let's say if I had the 115 strike price, let's say this is the 115 strike price, based on the market price back at that time, right? You will see this in the other videos that I created. The intrinsic value is basically the difference from the market price to the strike price. Now, if I were to roll this to the 80 strike price, it just means that right now I have to top up this amount. Right? Previously, if the market was to drop past 115, I'm not going to lose any more in terms of intrinsic value. The intrinsic value I only can lose for the amount that I can lose is whatever I paid for. If the market was to drop below 115, I cannot lose more than this 115. I already lost the maximum intrinsic value. Everything else will be extrinsic value loss, right? Now, if I was to roll to the 80 strike price, right now I need to top up this amount. I top up this amount from 115 to 80. There is roughly about a 35 points increase. So that means I'm going to top up an additional $3,500 for this. Now you might be wondering, why do I want to do that, right? Why do I want to pay up even more, increase my risk, rather than just roll to the same strike price? And the reason is because of the break even, right? The break even as well as the delta gain. Now, let me just remove all of this so you can see it more clearly. Now, if I were to take a look at the overall break even right now, this is how we will calculate it, right? So first we will take the amount which we paid for this, all right? So we paid 38.6 for this, and then we add on to the amount which we had initially paid for the LEAPS when we first bought it at the start. It's plus 115, and then now we add the strike price that we have right now, which is 80 strike price. So we plus an $80, 80 points. Now we get a break even of 233.6. So now our break even is 233.6. Now previously, if you recall, just by rolling out using this amount, our break even is actually at 239.6. So if you notice, our break even actually increased by rolling out, right? Although you pay lesser, your break even is actually much higher because all you're doing is just paying extrinsic value. But whereas for rolling out and down, you're topping up your intrinsic value and you're only topping up very little in terms of extrinsic value gain. And in fact, the extrinsic value gain is only $3.60. So in a sense, while you are increasing the capital of the trade, your break even is actually lower. And the other plus point about rolling out and down is because of the delta. Right, so you see here, if you were to roll it out just to the same strike price, right, the same strike price at 115, which is this one down here, right? So on the way down, you started to lose, let's say 0.92, right? You're losing 92 cents for each time the underlying stock moves a dollar down. You're losing 92 cents. But then if you were to re-establish the same strike price, you will start out with 0.87. Right? So on the way up, of course, it increases and this decreases, but as the starting point, right, what you're doing is that you're actually losing more on the way down, but then when you make on the way up, you're actually making slightly lesser, right? You're making 0.87, 0.88, 0.89, 0.90 on the way up. So what it means is that from the point of time when you entered the price, let's say this is the entry price, I'll put E down here as the entry price. If the market was to just go back up to the same point as when you first bought it, but because you have rolled out to the same strike price, you notice that you actually do not make back the money that you had initially lost on the way down. That is because your delta is much lesser, and that is why your break-even price is much higher. But if I was to roll to the lower strike price, right, to the 80 strike price, you notice I start out at 0.94. So if I were to start out at 0.94 and as the market goes up, it increases to 95, 96, 97. It means that on the way up, I actually make more than on the way down, which also means that the moment it goes back to my entry price, right, when I first entered into the LEAPS initially, I will be at a break even or even at a profit at this point of time because I make more on the way up. So that is why I always choose to enter into a roll out and down rolling for loss if my call leaps option is in a loss. So these are the two things that you need to think of when you're rolling. Now, of course, if you don't have that much of a capital to continue rolling out and down, or you do not want to take on more capital risk, then you can of course just roll out to the same strike price, right? But if you are no longer bullish on the overall stock, then it's best to just close out your stock, get out for a loss, and then enter into another trade altogether. All right, so let's have some takeaways. So the first takeaway is that rolling your deep in the money call leaps helps extend the lifespan and continue the bullish view on the underlying stock. So this is the keyword down here. You must still be bullish on the underlying stock. If you're not sure or you don't think the market will go up, then there's no point to extend the lifespan, because what you're doing is that you're only further increasing your risk and you're going to lose more money if the market doesn't go up in the long term, right? Remember, when you're rolling, you're always taking on more extrinsic value risk. Next, that is why you always want to roll if you're still bullish on the underlying stock. Next, you want to roll when the DTE is less than 90. Again, it's because that there is a higher theta decay as the time frame of the options gets shorter. Now, if it's in a profit, you roll out and up to take some profits off the table and you re-establish the initial delta of your position. So this will take some risk off the table. So basically, as I mentioned, you will be rolling from somewhere from a $0.95. You want to roll back down to 0.90, take some profit, take some risk off the table. But if you're in a loss, then there are two options, right? So you can first start off by rolling out to re-establish the same strike price. But in this case, you'll be paying more in terms of extreme value, but you keep the same intrinsic value risk, so you do not increase your capital risk in terms of intrinsic value. So you're just extending the time value of your call leaps option. That's rolling out, but you will always have a higher break-even price, so to keep in mind that. Next will be roll out and down to re-establish the same delta. So in this case, you'll be topping up your intrinsic value, but you'll be paying lesser in extrinsic value. So in this case, you will have a lower break-even point, right? That means it's easier for you to make money as the market goes up. Now, both will increase your initial risk and break-even point. So this is one thing to understand. So you must, again, I stress this, you must still be very bullish on the underlying stock. And finally, it extends your time to be profitable, because if your view does play out in the long term, especially if you're looking at this in a very long-term view for a couple of years, then it does make sense for you to increase the lifespan and roll your deep in the money call leaps out to a further expiration date. Alright guys, so I hope this video has been helpful for you. If it has, I'd appreciate if you give me a thumbs up, as well as subscribe to my video. And as always, thank you for watching. I appreciate your time, and may the options favor you.